Okay, good evening and welcome everyone to our new beginner options course. This is part one of a three-part series. My name is Tony Zhang. I'm the chief strategist here at Options Play, and I'm really excited to embark on this journey with you guys. For those of you that are new to options trading, and even for those of you that are experienced in options trading, to really go through a course to show you the benefit of options, how to go about using options responsibly in your portfolio, and making sure that you understand the fundamentals of options trading before we move on to looking at more advanced strategies and talk about how to utilize options for specific scenarios in your portfolio. So I'm really excited to get started with you here tonight. And again, this is part one, and we're going to talk about the benefits of options trading. We're going to jump ahead a little bit today, where we're going to look through if you spent all the time to learn about how to trade options, which typically for many people might take anywhere from a few weeks to a few months time to really learn how to trade options, I want to jump a little ahead and assume that you've gone through all that education and take a look at what can you actually get out of options trading for your portfolio and start there. And once you have a grasp of how options trading can be utilized in your portfolio, then we can start talking about some of the basics and fundamentals. We're going to go over some of the basics of calls and puts. And many of you that are experienced in options trading, I hope that you'll learn something as well, because some of these fundamentals, when we're thinking about trading, we don't think about some of these fundamentals. So I want to go over them with you. Make sure you truly understand it, because it's going to help your understanding of more advanced strategies and help you better understand some of the topics we'll be covering in part two and also in more advanced courses. So before I get started, just a quick disclaimer. What we're going to discuss here is purely for educational purposes. It is not a solicitation to buy or sell any specific securities. And to access the tools that I'll show you here today, you can access them at optionsplay.se. If you do not already have access to the free Options Play Nordics platform, I highly recommend you to sign up if you're interested in learning more about options, because you'll get access to free bi-weekly options education just like you are on today. More importantly, you'll also get access to our free on-demand options video library so that you can view all the previous courses that we have provided. And lastly, for those of you that are already at the stage of implementing options in your portfolio, we send out weekly cover call and short put reports, as well as trade ideas every single Friday. So you can access all of those simply by registering for free at optionsplay.se. Now, today, what I'm going to cover is, again, this is part one of our Beginners Options Master Course. Today, we're going to cover really thinking about why should you trade options. So again, jumping ahead, assuming that you've already learned how to trade options, what benefits can options provide for your portfolio? We're going to cover things like what type of income strategies can you look forward to. Generating income in your portfolio, in my opinion, is one of the primary reasons why many people utilize options. It's the most popular strategy also, if we look at trading volumes. The second most, I think, important usage of options is really allowing you to apply leverage, but do so in a way with limited risk. And then once we understand that, we'll talk a little bit about call and put basics. I want to go through the understanding for everyone to know what a call and a put is before you actually start thinking about these strategies and what are best practices for each one for the more advanced strategies. And make sure you join us for part two, where we're going to cover buying versus selling options. We're going to get into the mechanics of buying versus selling calls and puts. And lastly, March 18th, we're going to go through a real market analysis. This is where all we're going to do is spend time looking at the markets together. We're going to throw out some ideas with each other. We're going to throw ideas, and we're going to show you how to utilize options play to leverage your ideas using options, both buying and selling options, and giving you a forum to be able to ask any questions that you have regarding the things that we covered in part one and part two. So before I get started, I just want to do a quick poll here. I just want to get a sense for What is your current options trading experience? I just want to get a sense for the audience here in the room. So please just vote on the poll on your screen. You know, do you have some knowledge of options trading? Do you already learn, are you already trading options, or are you in the process of learning how to trade options? Okay, so far we have a pretty interesting spread here. It looks like the majority of you are just learning how to trade options. A few of you say that you have no prior knowledge of options trading. That's okay. We're really starting from the very beginning here. And about, a third of you say that you either have some experience or you are experienced in options trading. Okay, so, most of you have voted already, so let's just share these results again. 58% of you are learning how to trade, 12% have no prior knowledge. So basically 70% of you are in the learning process. So the Beginner's Master Course is really designed for those of you that are beginners and just in the process of learning how to trade options or just starting out. For the 30% of you that have said that you have some experience or you are experienced in options trading, I hope that this provides you with a better understanding of the fundamentals, because the fundamentals are so important when you're really looking at the more complex strategies and in some of the later courses. So I hope that you're able to learn something new today for those of you that are experienced in options trading. Now, since 70% of you said that you do not, or you're just learning how to trade options, I just want to get a sense for how many of you already have an options agreement, meaning how many of you have an options account at your brokerage firm? Have you applied for an options account, or some of you are not sure? I just want to get a sense for how many of you have an options account and how many of you do not. Okay, so with about a third of you voting, almost 45% of you say that you do not have an options account, and 50% of you say that you have an options account. Okay, so it seems like we're about a 50-50 split. So for those of you, the 44% of you or so that say that you do not have an options account, after you take the learning process, what we can do is we can help you with opening up your options account. So one of the things that we want to make sure that we help you with, not only understanding options, but knowing how to go about opening your account at your brokerage firm. So those are some of the things you'll look forward to as we go through more options education with you. For those of you that said that you do not have an options account, if you could bring up your chat window at the bottom of your screen, and please just type what brokerage firm or what bank you currently have your trading account with. This way we get a sense for which banks we need to reach out to, which firms that we need to reach out to, and get you the proper paperwork and understanding as to how to go about opening your account. Okay, so I know a lot of you trade at Avanza or Nordnet, so if there are any other ones that you trade with that you don't have an options account with, please type them into the chat window, and we will make sure that we get you the proper instructions and paperwork and contact information you need to be able to open up your options account. Okay, perfect. So let's go ahead and get started here. So let's talk about why should you trade options. So this is, again, looking a little bit ahead. This is assuming that you've already learned how to trade options. What can you use options for, right? So first of all, what we're all here to do predominantly is we are here to participate in the markets, in my opinion, right? Meaning we have views in the market, whether it's in the Swedish markets, Nordic markets, perhaps even US or global markets. I see some of you trade at Saxo, some of you may trade other markets, including currencies, right? There's a lot of different markets that we can trade, and we're all here because we want to participate in some way, shape, or form. Now, there are many ways to participate in the markets, and that's what's really unique about options, is that when you're a stock investor, there's really only one way to participate in the markets. When you're trading options, you have a variety of ways. So I want to go through what those ways are. First of all, first and foremost, many people come to options first time learning about options because they learn that options can apply leverage, meaning they can control a certain amount of shares or stock without having to put up all the capital required to buy that stock. So first and foremost, most of users, they're interested in applying leverage. They want to be able to leverage their 10,000 crowns or 20,000 crowns or however much you have in your trading account and control a position that's larger than that account size. And what you'll learn about options is that not only can you apply leverage on your capital, you can do so in a way with limited risk. And this is what's most attractive, in my opinion, for many beginners with options, is the ability to apply leverage, which many times you learn as is a double-edged sword, meaning it can work in your favor if you call the direction correct, and it can really work against you if the stock goes or the market goes against you. So options allow you to apply leverage when you're right, but do so in a way that has limited risk so that when you're wrong, you're not blowing up your entire account. So that's the primary reason as to why we see a lot of investors start looking at options. But once they learn how to trade options and once they learn about calls and puts, where we actually see people put their money in is predominantly in income generation. So this is by far the most popular strategy utilizing options. And it's because there's no other way to generate income using stocks. You can only do it utilizing options, and there's a variety of ways to generate income, whether you want to buy a stock, whether you want to sell a stock, whether you don't have any interest in owning any stocks. There are option strategies that allow you to generate income. So that's first and foremost why, in my opinion, most people end up utilizing options for income generation. It's because this is something you can't do in any other asset class. And lastly, creating customized payoffs. What do I mean by that? So when you trade a stock, there's really only two payoffs. You either buy the stock and the stock goes higher and you make money, or the stock goes lower and you lose money. So it's a very simple payoff graph, right? So if the stock goes higher, you make money. If it goes lower, you lose money. But with options, you can do a lot of things. With options, you can assume that the stock is going to go up to a certain point and then maybe go down to a certain point, or maybe go up and then down a certain point. And you can structure customized payoffs that pay you if the stock goes in specific directions within a specific amount of time. And you can get really complex with this. You can believe that the stock is going to make a directional move. You can believe that the stock is going to trade sideways and just trade within a range, or you think the stock is going to make a big move in one direction or another, but you're not sure which direction it is, but you just know it's going to make a big move and be able to bet on that. And there's no other market in the world or asset class that allows you to create customized payoffs outside of options. And once you really learn about the advanced strategies and options, the world is your oyster in terms of how complex you can make it. I'll be honest, with options, I do prefer to keep things simple. But if you're the type of person that wants to place very complex views on the market, you can do so utilizing options. Once you learn how to utilize options, what we tend to find is that there's a lot of use for options to help you protect your portfolio. So many of you may invest in stocks. You may be long-term investors in stocks, and maybe you have some stocks that you've purchased a few months or maybe even a few years ago that have performed very well, that you want to continue holding on to it, but you're concerned that the markets may pull back because of global concerns about risk, whether you think the coronavirus is going to get worse or you think maybe the Europe's economy is decelerating and you're concerned about a recession in local markets. Options can really be utilized to protect your portfolio. So risk mitigation is one of the primary reasons that we see a lot of investors utilizing options. So those are the primary reasons that people utilize options. And today we'll explore a few of those. So first and foremost, I talked about generating income. So especially in a low yielding environment, and I know the Swedish central bank recently just moved interest rates above zero, but it was negative for quite some time. And right now there are $12 trillion of global fixed income that is yielding negative interest rates. Earning income is difficult to do in this current environment, using fixed income, even through dividends. So options is really a tool that you can turn to utilize to generate income. So many times the income generating strategies that we talk about actually don't really involve options trading at all. It really involves trading stock, meaning buying the stocks that you want to purchase and then hopefully selling those stocks in the future utilizing options. And this is something I did touch up on for those of you that have watched some of my education in the past on how to utilize options to enhance your equity positions. But what you'll learn is that for income generation, it really has nothing to do with trading options. It's really utilizing options as a way to buy and sell your securities in your portfolio. And when you use options to buy and sell your securities as opposed to a limit order, you can generate yield. And that yield many times can be significantly higher than the dividend yield or the yield that you might get on a fixed income product like a bond. So that, in my opinion, is one of the first uses of options that most beginners should learn with. And then once you learn that, you can then go into more advanced strategies. So when it comes to selling, when it comes to income strategies, selling cover calls is going to be the first strategy you're going to learn as a beginner. As you advance your options experience, you're going to learn cash secured puts. In my opinion, these two really go hand in hand, meaning once you learn how to sell cover calls, you should learn how to sell cash secured puts immediately, because the two really go together very well. And lastly, as more experienced traders, as you learn more about options trading, you might take those cover call and cash secured put experiences and apply them to selling credit spreads. But that's a more advanced strategy. That just gives you an idea as far as what to look forward to as you progress your options education. But you always want to start with cover calls and cash secured puts. These are all strategies that I will be covering with you guys over the next few months between the beginner options courses, the intermediate, and the advanced option courses. We're going to cover basically everything you need to understand these strategies and know what other things you need to look out for to be able to implement these strategies in terms of best practices. And for those of you that are, the 30% of you that have responded that you already have experience trading options, we already send cover call and cash secured put reports to you every single Monday. So if you're registered for Options Play, you're already getting these reports. So for those of you that are already past that learning experience, you can start implementing these immediately using the reports that we send you every single Monday. And if you have questions with that, feel free to reach out to us and we're going to help you with that process. The second, like I said, the reason that most people come to options trading at first is because of the attractiveness of being able to use leverage with limited risk. So the goal here is to really allow you to trade with limited risk and potentially a smaller amount of capital. So to control 100 shares of stock many times may require a significant amount of capital. Using options allow you to do so to control that same 100 shares with just a fraction of the amount of capital that would typically require you to buy those stocks. And this, most importantly, allow you to do so with limited risk, despite the fact that you're applying leverage to the trade. So trades that we're going to cover here today is buying a call option, which is a beginner bullish strategy, buying a put option, which is a beginner bearish strategy. We're going to dive into these two strategies today. And I want to show you why just calling it a bullish strategy for calls and just calling a bearish strategy a put is not quite 100% true. Even though for those of you that have some experience trading, or even for those of you that are learning, you learn that a call is bullish and a put is bearish, but it's not quite true. So I want to make sure that everyone understands why it's not quite true so that you are more informed the next time you go and attempt to buy a call or put. Once you learn calls and puts, that's when the fun can really start, by really utilizing the power of options, which is the more complex, the more structured payoffs that you can trade using debit vertical spreads, which is an intermediate strategy that adds onto buying calls and puts, and then a more advanced strategy, credit vertical spreads, which is adding onto selling calls and puts. So today we're going to cover the basics of buying call, selling call, buying put, selling put. And then what we're going to learn in future times is how those four strategies can be enhanced even further by using vertical spreads. But that's for a later date once we get through the beginner stuff first. Lastly, mitigate your portfolio against market downturns. This again is really, again, has nothing to do with options trading. This has to do with your equity portfolio. Think about your equity portfolio. How many of you own stocks or ETFs in your portfolio that has had significant gains since you've purchased them? Please type 1 into the chat window if you've bought some stock in the past or ETFs that you just have some significant gains on that you're concerned that you'll give them back if this market pulls back. So please type 1 into the chat window if you are concerned about that. Okay, so I see a bunch of 1s in the chat window. So for those of you that have equity positions that you're holding on to, maybe you hold on for dividends, maybe you think the stock markets are going to keep going higher, but you're always concerned in the back of your mind, what if you wake up tomorrow and the coronavirus gets much worse, or North Korea attacks, sends out another missile and markets crash 5-10%? You know, what does that do for your portfolio, right? And these are things that it's hard to control. So first and foremost, you know, options can really be a tool that you can utilize to mitigate risk. So we want to show you how you can utilize put options to help you protect yourself against a market downturn and really protect your equity investment. And that's predominantly one of the major use cases of options for your portfolio. And this is if you have no interest in speculating on the markets, right? This doesn't require you to have to want to apply leverage. This is simply used to protect your existing portfolio. So buying puts is a beginner strategy. That's something we talked about earlier as a bear strategy. Or you can buy put spreads, which is a debit spread, a more intermediate strategy. But these are both strategies that you can utilize to help you protect your portfolio against the downturn. So those are some of the things that you can look forward to as you progress with your options trading, and think about which one of the things do I want to achieve in my portfolio? Do I want to generate income? Do I want to speculate using leverage but limited risk? Do I want to protect my profits on my equity positions? You know, if you do for any of these things, this could be your motivation to go through the options education. And I want to be clear that learning how to trade options is not and I wouldn't say it's the easiest thing in the world. It takes time. It takes patience. So I just want to have everyone understand what to look forward to. What will you get at the end of that, to help motivate, you know, to motivate taking the time to learn how to trade these specific strategies. So now that we've kind of jumped ahead a little bit, look through, you know, what are those benefits? Let's now look at some option basics. Now, before I talk about the option basics, I just want to get a sense for the audience here in the room. How many of you feel that you want to look forward to one of those ways of utilizing options in your portfolio? Please type 2 if any of the ones that I just expressed before: income generation, speculating with limited risk, or hedging your portfolio is something that you want to apply for your portfolio. Please type 2 into the chat window if that is for you. Okay, so I see a lot of 2s, which is great, meaning you guys have something to look forward to. You guys have something that you want to learn how to do for your portfolio. You know, and that's what I'm here to do as part of these beginner and intermediate option master courses, is to help you get to that point and help you gain the understanding you need to be able to utilize option strategies in your portfolio. So let's now talk about options. An option is simply a contract, right? So a lot of times, you know, when we talk about a stock is a piece of a company. An option is nothing but a contract between two parties. Now, I hate this particular slide because for those of you that attended the OIC webinar last week or the week prior, you learned this already. But it's so important to learn that, but I absolutely hate this slide because it's a bunch of legal jargon. The same way, because it's a contract, what you're reading is effectively legal language. So an option contract, and I'll read it right now, but more importantly, what I want to do is I want to show you what this actually means. So an option contract provides the buyer of the option the right to, but not the obligation to buy in the case of a call option, or sell in the case of a put option of an underlying stock or ETF at a specific price on or before a specific date. Now, that's a mouthful. And anytime someone reads this for the first time, you're going to probably have to go back and read it about 7 times before you truly understand it, if even that. So today what I want to do is I want to break down what these 3 points actually mean and go through some examples so that you have a much better understanding of what it means to be the buyer of an option and what it means to be the seller of an option and what it means to buy a call option and what it means to buy a put option and what the strike price and expiration date really have to do with all of these things. So those are the few things that we really need to pay attention to for an options contract. Now, the one thing I will stress that it's important to know about these things before we jump on is that an option buyer pays the premium, meaning the option buyer is always the person who pays the seller, and they have to pay the seller to enter this contract. So the option buyer always pays the seller to enter this contract, and by entering this contract, the buyer has the right to, but not the obligation, to buy the stock at a specific price on or before the specific date. Okay, so again, like I said, this is a mouthful. Most people, I think, when they read this for the first time, usually do a second take and say, I have no idea what that means. So what I'm going to do is I'm going to do a quick poll here. I just want to know, does the information that we just covered on this slide make sense to you? Yes or no? Just to get a sense for here in the room. And it's okay to answer no, okay? For those of you that feel that I don't really get a sense for what I'm learning here. So, okay, a very good portion of you have said yes. Almost 90% of you have said yes. About 8% of you said you're not sure, which is okay. So let's go through a real example, and I think that's going to make things a lot more clear. Okay, so let's go ahead and move on to the next slide. So, like I said, there's an option is simply just a contract between a buyer and a seller. So what we have here is a buyer of the contract, which is the person who initiates the contract, and we have the seller. So the buyer, like we said, always pays the seller to get into the contract. And there are two possible contracts that you can enter. You can enter a call or you can enter a put option. So because you can either buy a call or a put, there are effectively 4 possible combinations of an option contract. You can be a buyer of a call, you can be a buyer of a put, you can be a seller of a call, or the seller of a put. So the buyer of a call has the right to buy a stock or ETF on or before a specific date at a specific price. The buyer of the put has the right to sell that stock or ETF on or before a specific date at a specific price. The seller of the call, meaning the person who sells the call option to the buyer, has the obligation to sell the stock on or before the expiration date at a specific price, because the buyer has the obligation to buy, so the seller has the obligation to sell it to them, and the buyer of the put has the right to sell, so the obligation on the put seller is to buy it from the put buyer. So again, this is still very confusing in my opinion, but what I want to do is I want to break down these 4 strategies and hopefully make it a little clearer to you. So first and foremost, what I want to get out of the way is, what do all of these 4 combinations mean? And a lot of times what we do see is some viewers are a little confused as to what is buying a call, what is selling a call, buying a put, selling a put actually mean. So first and foremost, one of the easier ways to remember what you're actually trading is by using simple multiplication. So what I've done here is I've used positive for buy and negative for sell, which I think is pretty self-explanatory. And I have positive for call and negative for put. And all you have to do is basic multiplication to get a sense for whether you're trading a bullish or bearish strategy. So buying a call is a positive and a positive, so that is a bullish strategy. Buying a put is a positive and negative, that makes it a bearish strategy. Shorting a call, which is a negative and a positive, makes it also a bearish strategy. But when you sell a put, you get negative and negative. That's how you get a bullish strategy. So that's one way that you can kind of use a simple trick to remember whether you're trading a bullish or bearish strategy. Now, what I'm going to do today is we're going to cover all 4 strategies, and I'm going to show you, just because we're calling this bullish bearish, that it's not 100% true, and I want to make sure you understand why it's not 100% true and what the true reality of these strategies are, because the nuances of it are so important for you to fully understand when should you use option strategies, or when should you use specific option strategies and when you should not, because without them, you are likely going to be applying options in the wrong way. So it's really important for us to understand that, okay? So the best way for me to teach these 4 strategies is to walk you through all 4 strategies. And it's going to be fairly simple for me to do so. So first off, what I'm going to start off with is buying a call, which gives me the right to buy a specific stock or ETF at a specific price on or before the expiration date. So I'm going to walk you through what it means to be a call buyer, and then what I'll do is I'll show you what it means to be a call seller, to show you basically the opposite of the two. So let's say in this particular case, I buy a 2-month call option. The strike price is at 100 crowns, and I buy the 100 crown call option, and I pay 3 crowns for that option. So the call buyer pays the seller 3 crowns for the right to buy this stock at 100 crowns anytime between now and 2 months from now. So I pay $3 for the right to be able to buy that. So what I'm going to do is I'm going to show you if the stock goes higher, what that means, if the stock goes lower, what that means, if the stock stays the same, what that means, because that's the best way to really understand why should you buy a call option? Why should you pay $3 for this call option? So let's go through the example of a call buyer. Let's say I buy this call option and the stock is currently trading at 100 crowns, right? So we know that to buy a call is a bullish strategy. So let's take a look at what that bullish strategy actually looks like. So let's say 2 months from today, the stock stays exactly the same. It doesn't move, meaning it maybe moved a little higher, but came back down, or moved a little lower and came back up. So 2 months later, the stock is still at 100 crowns. What does it mean to be a call buyer? So a call buyer, it gives me the right to buy a 100 crown stock that's currently trading at 100 crowns. So guess what? That transaction is basically worthless because I can buy a $100 stock for $100. I don't gain or I don't lose any money on that transaction. However, because I paid the call seller $3 initially to get into this contract, what is my net outcome on this particular trade? Can anyone guess what's my net outcome if the stock stays exactly the same and the stock is at $100? You can type it into the chat window if you have the answer. But the answer is I've lost 3 crowns. Great, exactly. A lot of people just answered lost 3 crowns, right? Because I can buy the 100 crown stock for $100. That's worth nothing to me. But because I paid 3 crowns to get into it, guess what? I've lost 3 crowns here, right? So I've lost 3 crowns. Now, let's say the stock is lower, right? Let's say the stock moved down to $95. What is this worth to me? So I can buy the stock at $100 that's only worth 95. There's no way in the world that I would ever buy something for $100 that I can just get on the open market for $95. But so I'm not even going to bother with that, with the right to buy the stock. I'm basically, this call option is worthless to me. But again, I paid 3 crowns to get into it. So if the stock declines to $95, guess what? I also lose 3 crowns. And basically this is true for any price less than 100, because why would I pay $100 for something that's worth less than $100? There's no reason for me to do that, right? So now let's say what happens if the stock goes higher? Let's say the stock 2 months from today is now worth 103. Now, guess what? It makes sense for me to buy the stock for 100 crowns because it's worth $103. Why wouldn't I do that, right? It's basically free money. I can buy something from the seller for 100 crowns and immediately sell it on the open market for 103 and realize a 3 crown profit. However, remember, I paid 3 crowns to get into this contract. So guess what? If the stock moves 3 crowns higher, my strategy has basically broken even, meaning I gained 3 crowns on exercising my call option, but I paid 3 crowns to get into it. So my net is going to be 0. Okay, does that make sense to everyone? Please type 3 into the chat window if that makes sense to everyone. Okay, perfect. Now, let's say the stock keeps moving higher. Let's say it moves up to 105. So now, again, I can buy the stock for 100 crowns. That's worth 105 crowns. So if I chose to buy the stock from the seller for 100 crowns. I can immediately sell it on the open market for 105. But again, I paid 3 crowns to get into it. So what's my net on this particular trade if the stock's at 105? Exactly, Nicholas, plus 2, right? And what you'll see is that as the stock goes higher and higher, I get to make more and more money, because guess what? I can buy the stock at 100, sell it for a higher price, and the only thing I have to take out of that equation is the 3 crowns that I paid on that call option. So what you're going to notice is that what you're going to get is a payoff graph that looks like this, which means that if the stock moves lower, even if it goes to 0, what I lose is 3 crowns. If the stock goes higher, I keep making more and more money. So this payoff graph, right? This this payoff graph, I think for most options traders that have started learning options, looks familiar, right? And this is how we actually get this payoff graph that we refer to with options, what we call an asymmetrical risk, because if you're right on where you think the stock is going to go, you can make more and more money. If you're wrong, you're only risking 3 crowns. If the stock even goes to 0, the most you risk is those 3 crowns. However, we said that in the beginning that buying a call option is bullish, right? However, what I'm showing you here is that there are examples where the stock can move higher, but I actually still lose money. And that is counterintuitive for many beginners, that I'm bullish on this stock, it moves up by 2 crowns, but guess what? I still lose 1 crown on this transaction. That's not really bullish, right? So to be true to the strategy, what you have to understand is that when we say buying a call option is bullish, that's not 100% true. What we're really saying when we're buying a call option is not only are we bullish, but we're bullish by a certain amount. What is that amount? That amount is the 3 crowns that we're paying for that call option. So whenever you buy a call option, you have to first look at how much is that call option, because that will tell you how far does the stock need to move in order for you to break even. And you have to ask yourself, do I think this stock in 2 months' time is going to be at 103 or higher? Because if I do think it'll be at 103 or higher, then I'll make money. But if it goes up to 101 or 102, which is still higher, but guess what? I'm actually going to lose money on that transaction. So it's really important that when you think about buying a call option, that you don't just think of it as bullish, but bullish by a certain amount. And that's a big distinction between just bullish and bullish by a certain amount, because that's the difference between making and losing money. So I want to make sure everyone understands this, that when you're buying a call option, you're not just bullish, you're bullish by a certain amount. And that's so important to understand that before you start trading options. So before I move on, I just want to ask everyone, make sure everyone understands this. I'm just going to do a quick poll. I just want to do a quick poll. Does the information we just covered on this slide make sense to you? Okay, perfect. 100% of you have voted yes. Great. That's exactly what I was hoping for, is that more of you understood it after seeing it visually. Perfect. Okay. So now what I want to do is I want to say, okay, now that we looked at that call buyer, right? We see what it looks like to buy a call. Now let's say, what happens to the person who sold that call to the person who bought it, right? So we're going to go through the same example. The person who's, instead of buying the call, you sold this call. And 2 months later, the stock is still trading at 100 crowns. What happens? So how many of you can guess what happens if the stock stays at 100 crowns 2 months later and you sold this call option? What happens? So Hans has it correct. Jonas, same thing. A lot of you have got this correct. So let's walk you through this, right? So I sold a 2-month call option for 100 crowns for 3 crowns. So I sold to someone this call option and I collected 3 crowns. Now, 2 months later, the stock is still trading at 100 crowns. Guess what? The call buyer can certainly buy the stock from me, which I will sell him a $100 stock that I have to go out in the open market and buy for $100. So it doesn't cost me any money to deliver this 100 crown stock to him. But because he paid me 3 crowns to get into this transaction, if the stock stays at 100 crowns, I make 3 crowns, right? So, whoops. let's see, I make 3 crowns here, right? Positive 3 crowns. And if the stock is anywhere below 100 crowns, that same statement is true, because guess what? No one's going to ask me to sell them a 100 crown stock that they can just buy elsewhere for $95. Why would they buy it from me for 100 crowns when they could buy it on the open market for lower? So what you're going to see is that a call seller looks basically the exact opposite of a call buyer, because the two parties are on the separate side of the transaction. So what happens if the stock rallies to 103? Guess what? Yes, as a call seller, I've lost money, because now I have the obligation to sell a 103 crown stock to someone else for just 100 crowns. So I have to go on the open market, I have to pay 103, and then I have to immediately give it to someone else for 100. I lose 3 crowns on that transaction, but I got paid 3 crowns initially. So my net is 0 on this particular case if the stock rallies 3 crowns. And what you're going to see is that as the stock goes higher and higher, this is where it becomes worse and worse for that call seller, because guess what? I have to keep selling something at $100 that's worth a lot more. So if the stock really rallies, then the call seller will lose more and more money. But if the stock stays where it is or moves lower, that's when I keep my 3 crowns. So what you'll notice immediately is that as a call seller, this technically is a bearish strategy, meaning I make money if the stock stays lower, but it's not technically bearish because the stock can actually move higher and I could still make money. The stock can move to 101, 102, and I still make a couple of crowns. I certainly don't make much money, but I still make some money, which is why just to say that selling a call is bearish, in my opinion, is not 100% true. Because what it really is, in my opinion, is that it's fairly neutral. You really want the stock to stay somewhere in this range. You don't really want it to move too much lower either, right? Because what I'll show you later is that if the stock moves a lot lower, there are better strategies to trade that will, because here, even if the stock goes to 0, the only thing you make is 3 crowns, right? Not a good outcome, in my opinion, to sell a call for 3 crowns, and if the stock goes all the way to 0, to not make any more money on it, even though it's a bearish strategy. But as you can see, if the stock moves higher, you can still make money. So to say it's bearish is not 100% true. So what you have to ask yourself is, as a call seller, is do I think the stock will be somewhere at, whoops, sorry, did not mean to do that. Let me see if I can bring that back. So this is what a call seller looks like, right? So we just talked about that. So what you're doing as a call seller is you're saying, how much can I sell this call for? And what you have to believe is that the stock will be at that level or lower, right? So if I can sell a 100 strike call for 3 crowns, what I'm basically saying is that I think in 2 months' time, this stock will be at 103 or lower. Which is a little different, in my opinion, than saying I'm bearish on this particular stock. And I want to make sure everyone understands that before I move on to the next one. So please type 4 into the chat window if this concept makes sense to you, right? And what's really important to remember here are 2 things. What is the strike price that I have to sell that I have to sell the stock to the buyer for, and how much am I receiving for entering this call contract, because that establishes this price here, right? And then I can ask myself, do I think this stock will be below that price at expiration? If I think it's going to be below that price, guess what? I'm probably going to sell them that call. If I think it's going to be significantly lower than that price, then what we're going to do is we're going to look at the next one, which is buying a put option. Okay, so I see a lot of 4s, which is perfect. So now let's just flip this on a dime, and what you're going to see is that it's going to be the exact same thing, but a mirror image of each other. So let's say now I buy a put option, right? So I buy a 2-month 100 crown put option. In this particular case, I buy the put option also for 3 crowns. And what you're going to see is that a pattern emerges, right? So what happens if the stock stays at 100 crowns? Guess what? I'm going to lose 3 crowns because I have the right to sell a 100 crown stock that's worth 100 crowns. So I make 0 on that transaction, but because I paid 3 crowns on that, I basically lose 3 crowns on the whole transaction. And this is true for any price above 100 crowns, because why would I sell something? Why would I sell a stock to someone for 100 crowns that I can sell on the open market for a higher price, right? This doesn't make any sense. If I can sell it to the open market for 105 or 110, I would never enter that transaction. So guess what? I basically lose 3 crowns on that transaction if I buy a put and the stock moves higher. But if I buy this put and the stock moves lower, let's say it moves down to $97, now I have the right to sell a stock that's only worth 97 to someone else, to the put seller for 100 crowns. So I make 3 crowns on that transaction, but again, because I paid 3 crowns to get into that transaction, my net on this is 0. So down here, I'm lost 3 crowns. Here I'm 0. And if the stock starts to move significantly lower, that's when I can start making some money on my put option. Because if I can sell the stock to someone else, to the put seller, for 100 crowns that I can buy on the open market for 90 or 95, guess what? I'm making money on that transaction. And all I have to do is take out the 3 crowns that I paid to get into this contract. So if I buy a put option and the stock moves lower, I make more and more money. So that's how we get the payoff graph for a put option, okay? But what we have to remember is that you paid 3 crowns to get into this put option. So not only do you have to be bearish on the stock, you have to believe that the stock is going to move at least 3 crowns lower or more before it makes sense for you to buy a put option. Because if you think the stock is going to move 3 crowns lower, guess what? Buying this put option is going to net 0 profits for you. Now, that's a tough thing to do, right? Because if you shorted the stock and the stock moved 3 crowns lower, you would make money. But when you buy this put option, you make 0 money. And that's in my opinion, one of the most difficult parts about trading options is understanding this rule of how far does the stock need to move in order for me to be profitable? And do I think this stock is going to move more than that amount? Because if I do, then yes, you should buy the put option. If you think it's going to be less, you should not buy that put option. And you have to figure out where that line in the sand is. And in this particular case, it's going to be at 97 crowns, okay? So does that make sense to everyone? This should be, if you understood the call side, the put side should be fairly simple. So please type 5 into the chat window if this makes sense to you. Okay, so again, you have to ask yourself whenever you're buying a call or a put, that not only are we saying you're bullish, but bullish by a certain amount. When you're bearish by a certain amount. And that amount is the price that you pay for that call or put option. And we're going to come back to this concept in future classes to discuss how do we actually determine, are we paying a lot or a little for this call option? And those are some of the things that will help you decide whether or not it makes sense for you to buy that call option. And lastly, let's talk about selling a put option. So selling a put option, how does that work? Same thing. You have an obligation to buy the stock from the put buyer. So here in this particular case, what we're doing is we're going to sell a 2-month 100 crown put for 3 crowns. And what you're going to notice very quickly, and I don't necessarily need to go through all of the examples, but the payoff graph for selling a put option looks something like this, which is just the inverse of a put buyer, right? So the put buyer looked like this, right? So the put seller is just the exact inverse of the two. Okay, so if you ever forget what it looks like, you can always draw the inverse of each other. But a put seller basically makes money as long as the stock stays above a certain point. And that point is dependent on how much capital they're going to receive for selling that put. So even though we call selling a put bullish, in my opinion, not really completely true, because the stock can actually move lower and you can actually still make money on this particular transaction. So what you're really saying when you're selling a put option is you believe that the stock is going to stay above a specific price. And that price is determined by how much you sell that put for. So if you sell the put instead for 3 crowns, let's say you sold it for 10 crowns. Now what it looks like is that, this is going to be 90 crowns, right? So you can, the more you sell a put for, the more buffer you have, right? and on the flip side, if you buy a put option for a much higher price, then the stock needs to move much more before you can make a profit. So this is really where buyers and sellers are constantly trying to seek out the best possible price. When you're buying, you want to buy a put for as cheap as possible. When you're selling a put, you want to sell it for as much as possible, because that is what determines when you can make money. So as long as the stock stays above 97, you'll make money. But if it goes below 97, you can lose more and more money. And that's the distinct difference between a buyer and a seller, is that whenever you're buying an option, you have limited risk. Whenever you're selling an option, you have unlimited risk. You're taking the opposite transaction as the call or put buyer. So that is the absolute fundamentals of understanding a call and put option that's going to really come into play as you learn more about these strategies going forward. So every more advanced strategy we talk about, whether we talk about basics like covered calls and cash secured puts, or if we're talking more advanced strategies like spreads, they are all based on these 4 fundamental strategies, because those are the only 4 contracts that you can enter. Everything else is just a combination of these contracts put together to create different payoffs that you're looking for. So depending on where you think the stock is going to go, you can customize these payoffs. You can buy a call here and sell a higher call somewhere else and get the customized payoff that you're looking for, but they're all based on these 4 fundamental strategies. So with that, that concludes what I wanted to show you guys here today. That concludes part 1 of the benefit of options, giving you a little look ahead as to what you can look forward to, giving you a brief, I would say, primer on call and put basics so that you can better understand some of the things we're going to talk about in the future webinars and courses, and hopefully giving you guys the opportunity to really start improving your options education with our options beginners masters course. So with that, I want to thank everyone for taking the time out here this afternoon. What I'm posting here is, again, how to access options play if you do not already have access to it. And for those of you that are new to options trading, we also launched a new options education website. So you can actually see some of our previously recorded webinars. If you're not ready for it, it's okay. Take your time with the courses that we're going through with the beginner's options course if you're brand new to this. However, for those of you that are a little bit more ahead, if you want to learn more about selling cover calls and cash secured puts, we have webinars already pre-recorded for you. Or if you just want to have a platform walkthrough of options play, you can view all of that using the link I just sent you in the chat window. So again, with that, I want to thank everyone for taking the time out here this afternoon. I have a few minutes to answer any questions that anyone might have, but I did jot down, the brokerage firms that many of you trade options with, and I'm going to reach out to those firms and make sure that we get the information for you guys as to how to open your accounts, your options account. So if you have any questions regarding anything I went over here today, please type them into the chat window and I'll try to answer as many questions as I have time for. And I think there were a couple of questions here. I think Hans asks, do you mostly wait until the end of an option to buy or sell? Hans, I think Hans's question is, if I buy a call option, do I hold it for the whole 2 months? Do I hold it to expiration? And Hans, the answer is that it really depends. It depends on the call option you purchase. It depends on whether you're buying versus selling. So there are lots of different scenarios, and it's hard for me to make a generalization. So what I will say is that generally speaking, when you're buying an option, you tend not to hold them to expiration. When you sell an option, you're more likely to hold it to expiration. But again, that's an overgeneralization. It really depends on a few other factors. So we will cover that when we talk about individual strategies, because again, it does differ from strategy to strategy. So great question, Hans. But you'll learn more about each individual strategy as to whether it makes sense to hold it to expiration or close it prior to expiration. Nicholas is asking, where can I see what it actually looks like when placing a call or put option? Great question, Nicholas. So we have a platform that allows you to do that. So let's say we're looking at AstraZeneca and you're bullish on AstraZeneca and you want to buy a call option. First of all, our platform allows you to search for a call option, analyze it, use the P&L simulator to see how these strategies perform, if they go higher or lower. And then more importantly, when you hit the trade button, we'll give you the details as to how to enter this into your broker's platform. Now, For those of you that already have a platform, I recommend that you can take this information. If you don't know how to enter that order, I recommend that you call your brokerage firm and have them help walk you through an options order ticket, so that you understand how to enter it correctly. It is something that we plan on covering in a future webinar, entering option orders. So I want to make sure everyone understands that for your brokerage firm. But it does depend on your brokerage firm, so I do recommend that you call your brokerage firm. Nicholas is saying, oh, I think I just answered that question. Oscar, you're very welcome. Do you need to own a buy a put before selling a put? So great question. So the question was, do you need to own the put first in order to sell it? And the answer is no. You do not need to own a put in order to sell it. You can just sell a put. And again, you want to sell a put if you think the stock is going to be below that price. So in this particular case, you sold a put for $3. So what that means is that by selling a put, you believe the stock is going to be above 97. So that is the only requirement you need to have to sell a put. Now, I will say that your brokerage firm is not just going to let anyone sell a put, because selling a put does have that unlimited risk, right? So your brokerage firm is going to ask you to post a certain amount of margin in order to sell the put, but that's the only requirement. You don't need to own the put before you can sell it. Hans, I think I answered your question above, Hans. Let me make sure. Yeah, I think I answered your question, Hans. If there are any other questions, Nicholas, you're very welcome. Hans, you're very welcome. If there are any other questions, please type them into the chat window. If there are no other questions, I just want to thank everyone for taking the time out here this afternoon, or this evening rather. I really hope that you guys have found this part one useful for your options education, especially since so many of you said that you're just in the learning process. Again, it's so important that you understand the fundamentals before you move on to the next one. So I hope that you guys learned something. I hope that you guys enjoy it. And please, if you have the time, watch the recording, especially if this is brand new to you, before you attend part two, because we're gonna keep building on top of what we learned here in part one in part two, and then apply it in part three. So I hope that you guys are able to take the time and learn more, and hopefully this inspired you to understand what you'll get at the end of all of this, because sometimes you learn about calls and puts and you get a little frustrated and you say, what am I even doing this for? And that's why I wanted to look a little ahead and show you what can you actually get from options trading. So hopefully that gave you a clearer picture for that as well. So thank you so much. I hope you guys have a great evening, and I'll see you guys in 2 weeks on the next part two. Have a great evening.